Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it's likely to be a slow week for the market, although maybe a good week, which is not necessarily such a good thing in the context of an option structure that you put on for the portfolio a couple of weeks ago, which was a short position. However, you've implemented something to hedge yourself against that. But before we talk about that, let's have a look at the top 40 and the S&P 500 rather to start with, given where we are in the markets.
Yeah, that's right. So let's have a quick look at the S&P 500 and paint that as a background picture, and then we'll have a look at our top 40 and take it from there. This is the same chart that I showed last week, just slightly advanced, obviously a week's extra trade. It's the chart of the S&P 500, and what I identified last week was the downtrend that goes back to the tops from the high of last year, in around July last year, and it comes in at around 2,080 on the S&P 500 here. Also, recently we had a double bottom down here at about 1810 odd on the S&P, and that double bottom gets confirmed when the price action moves up through this higher line here. So that looks like a W down there. Once it actually takes out that high point, that then validates that double bottom pattern. And then what you typically do is you take the height from the double bottom to that midpoint and you project that distance up to get your target. So that points to the same target level of about 2080 for the S&P 500. So we're getting up there now. We're trading at about 2050 at the moment. The market is getting pretty overbought. If you have a look at the RSI, the relative strength index on the top there, you'll see it's at very, very elevated levels. Any reading above 70 on an RSI is considered quite overbought, and it's sitting at 69.51. So it's right there on the cusp of being very, very overbought now. And then also, if you have a look at your stochastic oscillator, which is at the bottom here, there's actually a little bit of negative divergence evident on that graph as well. And when you see negative divergence like that, that sometimes can mean that the upward momentum of this rising trend is starting to lose its momentum. So we'll see. Maybe there's room for a little bit further upside here, but there is a fair amount of resistance up ahead. And from there, it wouldn't be too surprising to at some point then see a bit of a pullback for the US market.
I mean, to some extent, the same thing is playing out in the top 40 index because it's rallied way above, I think, where a lot of us thought it might a little while ago, and obviously you'll get to that. But is it also looking as if it might hit the same sort of levels and approach highs that it hit in October last year?
It's possible, and again, this, like you said, we would never have expected this a couple of weeks back. Things were actually looking relatively bleak, and all of a sudden we've had this massive rally from the end of February to now towards the end of March. I mean, the gain that we've seen in this market has been tremendous. What we've got here is this 46,700 level on the top 40, which has now been broken to the upside. And I don't know that I believe this, but that you could say that whole thing there is like a crude inverted head and shoulders. The right shoulder is not very well formed, so I'm a bit questionable on whether that is the case or not. But be that as it may, the fact that it's broken through this lateral resistance level is short-term bullish. And the next technical level that I'd have in my sights really is this 49,000 level, which is the previous high that we saw in October last year and again in April last year as well. So, and that's not really that far away now. I mean, we're close to 48,000 now. It's only another 1,000 points and we're there. So if the S&P 500 were to get up to that higher target that I spoke of, then there's a possibility, I guess, that our market might very well also touch its prior high, which is tremendously surprising. Because as we sat here in January and February, I never would have thought this was likely. But it's a reminder again that anything is possible in the market, and you should never discount any potential outcome entirely.
Yeah. Now, what does this mean for the option structure that you put on for the portfolio? Does it put it at risk if the market were to head to 49,000?
It does put it at risk. So that's why I want to visit this and just show you what I've done to mitigate some of that risk now. The option structure is it's a bearish structure. We put it on in January, so viewers who want to go and see how we constructed this thing can actually go and have a look on either on my website, traderscorner.co.za, and have a look at the multimedia section, and all these previous shows are there, or also on the Business Day TV website. Anyway, the bottom line was that the payoff of this structure looked like this. So you've got below 47,000 and down to 43,000 on the top 40 index. Effectively, we ended up making a small premium income for that option structure. Below 43,000, we started to make quite nice money on it, and we made our maximum profit at 38,000. And my thinking was that there was a big band of lateral support here at about 41,500, and the market was looking increasingly vulnerable to breaking below that support level. At the time, I also thought this was probably a bear flag beginning to set up, and that would ultimately resolve itself to the downside. Alas, that hasn't worked out the way I thought it did. And it's gone up, and it's actually now breached above this 47,000 level here. And above 47,000, that red triangular area is where we actually start to, I call that the danger zone for this thing, because effectively I'm net written on call options there. So I'm short of a call option with a 47,000 strike. And that means that I would lose 10 Rand per point above 47,000.
So if the market were head to 49,000, you might lose theoretically 20,000 Rand.
Possibly, yeah,
okay.
That's right. Which is not, it definitely wasn't the intended outcome, of course.
No.
And it's not something I really thought was likely at all. I thought that I was selling away the risk high enough that it wouldn't be a problem. Anyway, here we are, and as I said, it's a reminder that anything's possible in the market, but you do have to take some sort of action when this happens. And I mentioned when I put the structure on that you can hedge these things if you need to. So I've implemented a partial hedge now, and what I mean by that is that I've gone long of 2 contracts of the IG markets, 2 Rand per point CFD on the top 40, and I've done that at an average price of 46,634. I'm a little bit ahead of the game here because there was a small falling wedge pattern that formed over here, and when that started to break to the upside, that was when I thought, right, it looks as if this market is likely to now push through 47,000, and I need to put some kind of a protection in place just to soften the blow if the market does rally further on. So what it effectively means now, if you think about this, is that I'm short 10 Rand per point, or I'm losing 10 Rand per point on the options if the market rallies.
Yeah.
But with these CFDs, I'm going to be earning 4 Rand per point. So the net effect is that I'm now only going to lose 6 Rand per point if the market continues to rally. So it's cold comfort. It means that the danger is slightly less, but it's not. I haven't entirely hedged this risk out.
Okay, I suppose that's the question. Why haven't you entirely hedged the risk out?
Well, because the counter argument is that what if it suddenly comes collapsing back down, and now I'm sitting where I should be making money on the options, but instead I'm now going to be losing money on a long CFD position. And it gets very tricky. Right? Trying to hedge these options positions around these types of
sort of inflection
points can be extremely difficult and frustrating, and particularly when you've got a market that gaps up and down aggressively overnight, as ours is wont to do from time to time.
Yeah.
So I'm taking a partial hedge on this at this stage. It's not to say I might not add a bit more to that hedge. But again, if the market were to start coming down and it starts to go below my entry point on those CFDs, then I'll close that and let the option do its work.
And the option does expire in June.
Yeah.
So, I mean, anything could happen in the next 3 months.
Yeah.
But I guess, as you say, you've got to have some sort of protection if anything does happen.
Well, this is the point. And I could sit here and think it's actually going to be quite an uneasy 3 months ahead if this is the way things are looking, to try and manage this structure and try and hedge it and monitor that hedge and continue to manage it. It's going to be tricky. But anyway, I put the trade on and I have to manage it.
Yeah. I suppose what's white knuckle times here on Traders Corner, Garth?
That's right.
Okay, so moving ahead from I don't know if you want to take us through any further detail on that option.
No, that's it really. I mean, there's nothing else to say. I would prefer it if the market came down from here. It would make life a bit easier.
Yeah, it certainly would. Okay, there is a trade that is working out, and I mean, not to sound facetious or anything, but it's been a tough year, and so I'm sure that you are very grateful for Life Healthcare, the long position that you took in this one.
Yeah, as a colleague of mine used to say, even the blind chicken picks a piece of corn every now and again. And I feel a bit like that lately. It really hasn't been a good start to the year. But yes, Life Healthcare, touch wood, is working at this stage. And what I'd identified last week was that there was this big overhead resistance level at 36 Rand per share over here, and then all these rising bottoms which go back to December. And what I said was that whole thing forms an ascending triangle pattern, and the rising lows is indicative that there's buying interest at the lower levels. So when this pattern resolves itself, the likelihood is that it will probably resolve itself in the direction of the strongest force, which would mean that the buyers are the strongest force, therefore it should probably resolve itself to the upside. Typically that's how these patterns do play out. Now the good news is that It is beginning to move higher. We have seen it trading above 36 Rand at the end of last week, and today it's actually quite firm again in a weak market, still trading above 36 Rand, which is encouraging. And what's also encouraging is that there's been a couple of days of reasonably elevated volume here, which saw the price pushing up towards this breakout level. And I think that could be quite telling, that we're seeing good volume coming through there. So what we did last week was we went long of 1,225 CFDs at 35 Rand 80, and the stop loss is 32 Rand 80 here, and I'm looking for a move up towards about 39 or 40 Rand, that sort of area. So it is working for us, and I'm happy to sit tight with this one and hold it. And my sense is that if we do get that break and it's more convincing and follows through, well, then it should be quite a powerful break and quite a bullish break.
Garth, I mean, just on, I suppose this is when the psychology of trading comes into account. In an ideal world, if you didn't have a TV show, for example, would you actually just take yourself out of the market entirely, or could you not afford to do that?
I don't think I'd take myself entirely out of the market. I would continue to trade, but in such a tricky environment, I'd trade smaller and not as actively, although we haven't been that active on the show anyway. I think you can't just walk away and say, well, it's too difficult, we're just going to leave it alone now. You still need to put an iron in the fire here and there, but you need to make sure that the trades that you select are high probability trades. And again, as we always say, you have to have a stop loss. You have to understand what the risk is that you're assuming on every single trade. But it is a difficult environment, don't get me wrong. I mean, this is tough. But,
when a high probability in a very confusing, volatile market where no one really seems to know what's going on, kind of probability becomes harder and harder to find. It's more like you're sort of shooting at possibilities rather than probabilities.
Yeah, it is a little bit like that at the moment. But having said that, there are still some fairly good technical setups. We have been out, not on the show, but on my website, we've identified some trades that have worked out very nicely this year. So you still have to continue to do the work, do the analysis, look for the trade setups and act on them. But as I say, in a difficult environment such as this, scale back your risk assumption. And I said to a lot of people, I don't know that this is going to be a year to make a fortune in the markets. I think it's going to be a year of maybe small gains and just survival, which unfortunately, with this big move higher that we've seen in the market over the last couple of weeks, survival is something that has unfortunately eluded a lot of people that I've come across. Being short the resources or short the top 40, and on the wrong side of it. And I've seen some really horrible stories out there of how people have been hurt in the short squeeze recently. I'm happy to say we've not been caught up in that, but it hasn't been easy. We're not making money yet for the show, but we've still got a long time left to try.
Yeah, still got about 9 months or so. So what does the portfolio look like then at the moment?
All right, so it's looking like this. We're still down around about 2% for the year to date. We've got the open trades that we've got there at the moment. There's our life healthcare with a small profit at this stage. Our option structure, now you'll notice I'm starting to market this thing according to the movements in the market. So we're losing 5,500 Rand there on that, but we're making 4,100 Rand on the hedge that I've implemented against that structure so far. So far that's fine, and I'm going to need to continue to monitor that option structure very, very carefully.
But, I mean, just on the option structure, are you still happy to use them, have them as a tool in the trader's arsenal at this point?
Yes, I am. I am still happy to have them. I think that they provide you with a fair amount of flexibility in terms of what you can do and how you can take a position in the market. I don't like to necessarily be naked short in the market, but I do like using an option structure like this to have it working in the background for me. If the market falls, that structure will work very nicely for us.
Okay, Garth, we'll leave it there. Thanks as always for joining us on the show. Garth McKenzie is founder and editor of Traders Corner.